Welcome back to my channel. Today I want to cover something that is very typical conversation that I have with my clients is to choose between investing in property and also investing in the stock market. So do watch this video. Cool? Okay. Of course, smash the like button and help me in my journey and subscribe to my channel. Okay, let's go to the screen share at this moment. Okay, so this is a commonly asked question: property versus stock investing. Which one will you choose? To me, it's not okay. Maybe I should not talk about my opinion at this moment. Let's cover the things that I want to cover with you. So there are 6 areas that we want to look at when it comes to investing in both these particular assets. So the first one is the returns on investment, ROI in short, value creation, liquidity, amount of capital, and this one is very important, which is the ease of diversification. And lastly, taxes involved. Okay, let me go straight into the first topic, which is the returns on investment. So what I did is basically look at the price index for Singapore property pertaining to the private residential. Because think of it this way, how many of us can own like multiple HDB? Cannot, right? So obviously let's look at the private, which is a non-landed residential. Ever since January 1995, the source is extracted from Singapore Real Estate Exchange, SRX itself. So what I did is very simple. I just want to go and calculate the annualized return for the last 25 years, from 1995 to 2020 at this moment. So the annualized return is about what? 3.8%. So exactly what most people are known is where property is to really preserve our net worth or preserve our money. Why? Because typically inflation in Singapore is about 2 to 3%. So in a sense, if you buy a property, you are going to preserve your wealth in a sense. Okay, based on 3.8%. Okay, valid. Okay, the next one is actually looking at the stock market. I specifically invest a lot of my assets in US, not so much in Singapore anymore. So that's why I'm going to use S&P 500 over here. So that's the table extracted from Yahoo Finance from January 1995, and using the annualized calculator, right? The last 25 years, the annualized return is about what? 8.6%. So to me, both the assets are pretty important. Why? One is to preserve wealth, the other one is to compound and grow my wealth. And it's always talking about purchasing power. Do you want to maintain your purchasing power or to have increasing purchasing power in years to come? So which one is better? Really up to you. But my suggestion is, why not both? And another thing about these two assets, right, is to understand the volatility. For property prices, it's unlikely that property price will drop like 25%, 30%. It is hard to find because most property investors, what they will do is when they buy something, right, they already pay a very high deposit or a down payment itself. Like say in today's market is 25%. So you already pay a 25% down payment, and that's why even the property price dropped by 25%, you are not going to sell it because you already paid that deposit. You're going to write over it. For stock market, likely to be a bit more volatile, but something that Warren Buffett always say about investing, about stock market, right, is basically like you are like a farmer that you bought the land, right? There are many people that own lands around you. So what people did around you is basically they buy and sell the land, and it doesn't really matter. End of the day, if you don't sell over the long run, investment is likely to go up. But true and not true, because end of the day is depending on what kind of companies that you invest, which I'm going to share with you later. Okay. So volatility wise, obviously, the stock is higher in itself. And there are ways to reduce the volatility for stock portfolio. Then the second thing that I want to talk about is value creation. For property wise, there's not much value creation we can do, right? If I only have like 2 or 3 properties, right? So a few things that I can do to enhance the property is one, is to add a fresh coat of paint. Secondly, the division of space to add a room to increase rents. But again, about this number 2, right, is very tricky. When I started investing in property, right, the number of tenants in a particular unit is about 8. At this moment is 6. I'm not sure whether URA or the government, they will reduce it, but do not play with the regulation. Okay, that's no joke. If they caught you in that, don't play with it. Okay, and thirdly is there's minor retrofitting that you can do to your property, or even renovation to increase or enhance the property value. Okay, for stock market wise, what we want to look at is really value-based investing. So 4 rules to it. Number 1, invest in business that you can understand, which is what Warren has been always talking about. Don't invest in things like, basically don't go into things that you don't understand, because why? It will be FOMO. Okay. And secondly is the track record of the company, like the management. So typically I prefer not to invest in IPO. Why? Because the results may not be consistent once they became listed as a company. I just want to maybe take a company that is like more than 5 years or 10 years in the industry itself to really look at the managers, how they are running the business. And third is financial measures. Talk about whether the management are very prudent, like is the profit margin increasing over time or reducing over time? The debt level, is it increasing over time or is it reducing over time? And likewise, the cash flow that they are generating from their business, is it enough to pay for interest, or etc, etc, etc. There's so many financial indicators that we can look at, but I'm not going to cover it at this point. And lastly is really calculating the intrinsic value of a business. There's so many financial models that we can use to look at it, but do take note that every business is valued differently also. Okay, the third thing is really liquidity. So it's pretty obvious. Okay, in terms of liquidity, obviously property is not something that is highly liquid. Why? Because imagine you are going to sell a property very quickly, right? It is deemed as fire sales, and you do not want to be caught in that scenario. For stock, it is easier and is quite quick for you to just liquidate a portion of it in case you need cash flow. So that's why, in terms of liquidity wise, it's actually better to have a stock portfolio over the long run. Okay. And another thing, when it comes to property, right, you don't really have active management. Okay, you cannot do like rotation. You cannot like buy a property today and you think that, hey, this property is not so good, right? You're going to move to another asset. Okay, but stock portfolio, you can do that. This company is not so good, I can move to other companies that are better run, other companies that are better managed. In a sense, for property, the decision will be like 5 to 10 years, and every decision is made with a very huge amount. It's like more than $500,000 to $1 million. For stock, not really. Okay, the decision that you make is slightly endurable. Okay, even if you make some small lesson losses, right, it is still recoverable in a sense. Not so much for property. Okay, and this one is another one. Is the very big topic. Why? Because it's talking about the amount of capital, and it's pretty obvious. For property, the capital required is higher. So let's do some calculation. Assuming you're going to buy a property that's about 1.2 million in Singapore, you need to do a 25% down payment. The remaining amount will be purely through bank mortgages, and there will be close to about there will be ABSD to it. There's a table to it also. With buyer stamp duty, there's a buyer stamp duty that you need to pay, and of course there is legal fee. So using that 1.2 million to really calculate the startup fee, right, is actually 275,000. So for property wise, it takes a bit of your time and your capital so that you can start investing. Okay, I'm not even including the running costs, right? Running costs like what? The property tax that you need to pay, the maintenance that you're going to pay, the private estate, and of course any repair that you need, which is wear and tear causes that you need to fork out in the event that the tenant itself never take care of your place. So if there's more people renting the space, obviously there's more wear and tear to take note. Okay, for stock itself is not very capital intensive. Why? Because let's look at this. For a medium income resident in Singapore, about 4,500, you can really start investing with 10% of your capital or your annual or your monthly income in a sense. If not, just save like $10 a day, which is $300 a month, to really kickstart your investment journey. So likewise, in terms of capital required, obviously stock market is lower. Next, the ease of diversification. Let's look at it this way. If you are going to have about 1, 2, or 3 property, do you think that it's easy for us to diversify? It is not easy, right, at this moment. Why? First question, there is an additional buyer's stamp duty. Okay, if you are going to buy a second property or a third property, remember I talked about the stamp duty, which is about 1 to 4% depending on the purchasing price. So to me, right, if you're going to own another property, is another 12%. Let's say 1 million is another 120,000, which is a lot of money in that sense. And if you're going to buy the third and the fourth and the fifth, is like additional 150,000 subsequent property that you purchase. Then on top of that, if all the property are under a mortgage itself, banks are not willing to lend you much money. Okay, there's another table to it. I'm not ever insert this, but you can always go and do your own research about it. But for stock market, you can really choose any stock market around the world. Obviously, there will be like currency losses, that you need to consider. But more important is you are not limited to just purely investing in Singapore. You can go any location in the world and look at any kind of company. But of course, follow the four method that I talked about initially. Okay, the business, your management, your financial measures, and of course the intrinsic value of the company. Probably future videos I will talk about it. Next, which is the last one, which is a tax involved. Okay, think of it this way. In Singapore itself, there is really no, generally there is no capital gain taxes. This is based on IRAS. But for property itself, okay, there is something that you need to understand. It's called the seller's stamp duty. Okay, for residential property in Singapore. And it's purely based on this table. So if you bought a property like way before, let's say 10 March 2017, there is a 4-year holding period for you. If not, you will need to, if you sell during that period, you will incur a seller's stamp duty. Then after 11 March 2017, which is the day you purchase the property, it is just 3 years. So there's a holding period, either 4 years or 3 years. If you sell after that period, is okay. There won't be it's like an additional seller's stamp duty. That is not like a capital gain tax. That is just a stamp duty. Purely, government do not want us to speculate the property prices, and they do not want prices to shoot up all of a sudden. Okay, that's the main reason why this stamp duty is being introduced to the property market in Singapore. And lastly, right, I mean, I really appreciate you to stay until this moment. If you really feel that there's a lot of value that is given from this video, please help me to like and comment below and support me in my journey. Be part of this journey, be part of this conversation. And lastly, subscribe to my channel and turn on the notification bell for future video. Okay, thank you for your time. Bye bye.